Hello, my name is Fabian Degen. I'm the founder and chief investment officer of FMD Wealth Advisors. This is the second episode of my podcast, Financial Friction. So, the topic this week is why the financial news cycle is working against you. The financial news machine never stops. Market alerts hit your phone first thing in the morning. News networks run real-time tickers around the clock. Social feeds are full of hot takes on whatever move the market's making today. It feels like staying informed, right? For most long-term investors, however, it's really just keeping you anxious. Before you can manage your relationship with financial news, it helps to understand what financial news actually is. News organizations are businesses. Their revenue depends on keeping you engaged, and engagement is driven by urgency, drama, and fear. Financial news channels need advertisers. Advertisers want viewers, and viewers are attracted to dramatic headlines. That means every down day risks becoming a plunge, and every correction risks becoming a crash. That framing is great for ratings. It is not great for your state of mind. Your ideal attributes as an investor, like patience, consistency, long-term thinking, are almost the opposite of what financial media is built to deliver. Once you see that tension clearly, it becomes a lot easier to stop letting the news cycle drive your financial decisions. So here is the core issue with watching financial news every day as a long-term investor. The news run on a 24-hour clock, but your investment strategy should run on a decades-long one. The stock market historically has a down day roughly half the time. That means on nearly half the days you check your market news, the headlines are going to be unsettling. But zoom out to a 5-year window, and the odds of a positive return climb to around 90%. Extend that horizon further, and those odds improve even more. Daily market news and long-term investing are simply not a good match. Trying to use one to guide the other tends to lead to decisions that hurt you. But keep in mind, not every scary headline is actually dangerous to your investments. Kevin Gordon, head of macro research and strategy at Schwab, draws a useful line between what he calls front page risk and bottom line risk. So, front page risk is a headline that shakes the market for a day or a week. Bottom line risk is whether that headline actually affects corporate earnings over the long run. Most front page stories never turn into bottom line stories. Geopolitical events, political drama, and central bank speculation all create a lot of noise. But if they don't affect the long-term earnings power of the companies you own, the market reaction usually fades. A good example is what happened in 2022. Energy stocks became the hot trade, driven by the Russia-Ukraine conflict and soaring oil prices. Many investors responded to that narrative and sold their technology holdings. But the underlying story for technology, like structural growth, decades-long growth driven by the digital economy, had not changed. Those who stayed the course were rewarded. Those who chased the headlines were not. So the loudest story at any given moment is rarely the most important one for your investments. So let's talk about the real cost of reacting. So the danger of too much financial news is not just stress, though that is real. The bigger danger is what the stress leads you to do. Research from Dalbar, a firm that studies investors' behavior, has found that the average investor consistently underperforms the broader market. One of the reasons for that are emotional reactions. When markets drop, people sell out of fear, then wait until prices have already recovered before getting back in. Over the past 2 decades, every dollar invested in the S&P grew more than eightfold. But miss just the 10 best days during that stretch, and you would have earned less than half that return. 10 days out of roughly 5,000 trading sessions over 20 years. So according to research from JP Morgan, investors who stayed fully invested in the S&P over a 20-year period grew their portfolio substantially, while those who tried to time the market based on news events consistently fell behind. To make it worse, many of the market's best day happened during the scariest headlines. The investors who moved to cash when things felt unbearable were often the ones who missed the recovery entirely. So let's talk about social media. Social media makes this even harder. If mainstream financial news carries risk, social media carries even more. A 2023 survey by the insurer Nationwide found that 34% of investors between age 18 and 54 had acted on financial information from social media that turned out to be factually wrong or misleading. Social platforms are built to generate strong reactions. In financial context, that usually means fear, excitement, or outrage, none of which are useful when making investment decisions. If your market signals are coming from your social media feed, that is worth changing. So none of this means going completely dark on financial news. Staying broadly informed has real value. What it does mean is being more intentionally about how you consume it. So a few things that help. Keep the front page out of your investment process. Any story that generally matters to your portfolio will show up in the business and financial reporting soon enough. You do not need to be monitoring every major news outlet to stay in the loop. Put yourself on a media diet. Only you can control the quality and quantity of media you consume. Avoid the temptation to doom scroll every piece of news that claims to have a definite answer on where things are heading. Ask the right question. When a headline worries you, ask whether it is likely to affect the long-term earnings power of the companies you own. If the honest answer is probably not, well, you should have your answer. Call your advisor before you make a move. When something feels serious enough to act on, that is exactly the right time to pick up the phone rather than make a trade. Don't swing too far the other way. There is one important thing to keep in mind here. Turning out the noise does not mean assuming everything is always fine. The stock market does go down, sometimes significant and for a long time period. Bad years happen, and they are a normal part of investing. Investors should avoid making emotional decisions based on short-term conditions in either direction, not just when the news are scary, but also when the market feels invincible. The goal is balance, the long-term conviction paired with honest awareness that markets are not a one-way street. The most important investment decision you make are often the ones you choose not to make. Staying invested when the news feels alarming, not selling in March 2020, chasing the hot new trade because everyone on social media was talking about it. The keys to long-term investing and long-term success are discipline and consistency, such as fighting the urge to sell when everyone else is selling, and staying the course when the market gets uncomfortable. That is not a passive approach, by no means. It takes real resolve. But it is a far better use of your energy than refreshing market headlines every hour and looking for certainty that the news cycle was never designed to give you. This was the second episode of Financial Friction. My name is Fabian. I'm the owner and chief investment officer of FMD Wealth Advisors.